let's bring in Bryce Doty. He is Senior Portfolio Manager at SIT Fixed Income Advisors. Chris Zaccarelli is Chief Investment Officer at the Independent Advisor Alliance. And Joe LaVorgna is Chief Economist for the Americas at Natixis. Joe, so, the part of what Rosengren is saying is that it takes a long time for us to even see the effect of rate cuts on the economy. How much is really going to change between now and a couple of weeks' time when they have to make their next call? I know we get the inflation data next week, but where do you think this really leaves them?
So when I heard that interview with Steve, I heard he's looking at retail sales and the inflation data. And if it's weak, he'll be on the side of rate cuts, which is interesting because what wasn't really spoken of in today's report is the fact that over the last 3 months, household employment is up 421,000. In the last year, the household sector has shown 3.6 million jobs.
It's amazing.
Listen, Kelly, that's 1.4 million more than the payroll data. So by some metrics, today's number was a gangbuster report.
Right. Well, so you're exactly right. There's been, we get the unemployment rate from one survey, the jobs added from another, and they're telling us two kind of different tales of the economy right now.
And I've been front and center on the Fed pushing for rate cuts. And I'm going to say something that maybe many won't think I'm going to say. I don't think the Fed should be cutting rates this month. Not after this report. No, I think you would wait. They should wait in December.
Yeah.
Well, to me, monetary policy is still too tight. But if the Fed really wants to be data dependent and wants to gain some credibility, this would be an opportune time to hold the line on rate cuts, come with a soft QE to deal with issues in the repo market, and save the rate cut for December.
Very interesting. Bryce, you agree?
Well, I'm amazed to hear that because it seems like everyone's kind of going, okay, cut. But you do look at these numbers and you do have to kind of stop and scratch your head. You're like 3.5% unemployment.
Right.
Normally they'd be raising rates, especially with inflation going up. But the cross currents and the confusion is the surveys, how people feel on ISM. They're looking weak. But then you see the actual numbers. The durable goods number was actually up, was very strong last week. And then you see the actual jobs numbers. Those are strong. It's almost like we need some measurement to be able to differentiate between the manufacturing sectors that are being hit by tariffs and the whole rest of the manufacturing area and the rest of the country.
Right. No, fair enough. Which is why people were looking to the services report. But, Bryce, I like your point. It's something Larry Lindsay said yesterday as well, that he likes to watch the hard data. The sentiment surveys are one thing, but he wants to know what is happening with the actual economy. So you're a fixed income advisor, especially here, which means you're right in the thick of this. What is your best guess as to what happens with, for example, the 10-year from here? I mean, with bond, what are we talking about? We got really out of whack in August. We came all the way back down to 1.5% on the 10-year yesterday. Where do we go from here?
Well, with August, we always seem to see the lows of the summer in August. There's just low activity, and so we were expecting a little bit of an uptick, and then we saw 3 months in a row of rising PCE and core CPI. Mm-hmm. So it was a little bit of a relief to see the wage number stabilize after spiking last month. So from an inflation perspective, we were getting a little nervous about how the 10-year could possibly stay this low.
Okay.
But the thing that's weighing on it is the liquidity problem. The Fed has still had to come in every single day since the Saudis were bombed to do this special injection of cash into the overnight lending market. And so that's keeping everything down. And I think that's a big reason that they would still cut in October.
Okay.
In fact, I think it's about the only reason.
So, Chris,
they need to solve this liquidity problem first.
Sure. Chris, let me bring you in on that then, because we have a couple of guests who are now skeptical of a rate cut this month that was almost fully priced in after the weaker data earlier this week. How do you position in the markets here then? I know it says you like technology, healthcare, and consumer discretionary.
That's true. And really, as you look at what's been happening with even Fed fund futures, looking at how the market's grappling with whether or not the Fed will cut later this week, if you looked on Monday, it was around 40% people believe that we'd have a rate cut at the end of October. As of yesterday, it was up to 85% after those two really bad ISM numbers. And then today, after the jobs report, not as bad as expected. Maybe that's come down a little bit. I want to say right before we went on air, I was looking, we were around 77%. So still, the market is expecting a cut later this month. And I think really what's happening is they're grappling with the trade uncertainty. The data has not been bad so far up until this week. The Fed was cutting rates in advance of when they otherwise normally would, especially with unemployment as low as it is. But I think they're trying to figure out how do they couch for the fact that the rest of the world is slowing down the trade wars impacting confidence. Up until this week, we hadn't really seen that confidence spill over into actual data, but that's what they're really grappling with. So I think the market's expecting them to cut later this month, again, just in advance of the trade war. Trade talks are going to happen next week.
Yep.
We could have some type of a breakthrough, some type of a truce. That would reverse that call, and I think we would not get a rate cut at the end of October. But I think all things being equal, we probably get a rate cut.
All right.
As far as the areas that we're looking at in technology, healthcare, and within consumer discretionary, we're trying to be selective. We're looking at specific areas. It's against our policy to mention specific names, but we're looking within medical device manufacturers, software and services, and also within consumer services. And we think there's a lot of value there given the risk-reward setup that we have right now.
All right. I have to leave it there. Joe, it is interesting to Bryce's point. Maybe at any other point, we would be talking about rate hikes, not cuts.
Yeah, well, I mean, the Fed is trying. The problem you have is the economy is not accelerated as much as they thought, and inflation, by their metrics, has consistently undershot target, and you're late in a business cycle. So you're right. The unemployment rate by itself would suggest rate hikes, but it's against the backdrop where people generally don't feel things are as robust as they could be, and the next shoe to drop would be slowing growth or a recession.
Yep. Guys, thank you all. Appreciate it today. Joe LaVorgna, Chris Zaccarelli, and Bryce Doty.